essentially required for banks. Why? Because they've only liquid assets funded by cash liabilities. Can they go bankrupt within a minute without the federal support? TARP provided federal support. TARP assets were temporarily distressed due to sudden liquidity impact, eventually sold at profit. We talked about that. All right. Recent example is Archegos Capital. So Archegos is what now it's called family fund. It's a hedge fund. They place large bets on a few stocks. Okay. And what happens when you do that? Prices were driven up by sheer activity of them buying several billion worth of dollars. So take a small company such as say Tesla. Okay, not really small, but in grand scheme of things, it is not that big. Sheer act of buying will drive up the prices. That's what happened here. Prices driven up through the purchasing activity, several billion dollars. Archegos takes profit, nearly 5 billion. So far, so good. When they take profit, they sell. Prices start falling with the unwinding. Okay, so large buying makes prices go up. To unwind that, large selling does the opposite. Archegos wins and Credit Suisse loses. So what's going on here? What happened here is Archegos did not directly buy the stock. They took a side bet with an investment bank or the investment bank operation of a bank holding company, Credit Suisse, with what's called a total return swap. And I have a little explanation of what that is later on for the students. So Archegos had total return swap with Credit Suisse. And how does it work? So in the next page, we'll see how that works. All right, so here we go. The total return swap of Archegos Capital, TRS, total return swap, essentially is this: short LIBOR and long returns on Viacom stock. Okay, and the deal is down here, Archegos and Credit Suisse. It's a side bet. Archegos says to Credit Suisse, I'll give you the losses, you give me the gains. Simply the returns. Forget about the underlying investment. So let's say $100 worth of stock, did it go up or down, and by how much? That's called a return. And that's what they're exchanging with each other, not the underlying investment itself. Okay? Pure returns daily of say Viacom CBS stock. And to support that, Archegos will pay Credit Suisse LIBOR. So Archegos pays standard LIBOR interest rate to Credit Suisse pays in return whatever happens to CBS stock. So that is the total return swap. And so far, so good. It's a regular bet. Credit Suisse hedges itself. So this is where problems happened. What did they do? They went to the stock market and actually bought the CBS stock by paying cash for it. So Credit Suisse, when they start buying this stock to support their bet, stock went up and they paid more and more and more. When they paid off, they sold the stock and prices fell. The more they sold, more prices fell. The losses are coming from here. And Archegos is happy getting their profits. The mistake that Credit Suisse did was betting on small number of stocks. If they had done this with a large index like S&P 500, probably would not have mattered as much. But betting on a small stock with large amounts it's easy to create this price impact sheerly by trading. Price rise and fall caused directly by Credit Suisse's hedging activity. Archegos, this guy, benefits, but bank loses. All right. So the next part I will talk about is the lost my document. Give me a minute. Okay. So Bloomberg had this report on the Archegos capital management. It says Bill Wong bought a handful of stocks using highly leveraged total return swaps. Stocks went up a lot and rapidly went down a lot. Archegos, the prime brokers who funded the bets using total return swaps, could not sell the stocks in time and lost billions of dollars. And very briefly, they explain what we said. The thing that happened is not that Archegos made large bets on some stocks. When they do that, the bets paid off. Archegos then took the winnings off the table. So when the stocks went down, there's no collateral left. Okay? So they won, the bank lost on the bet. All right. So next brief discussion is going to be on how to manage risk. So broadly, it's two categories, systematic and unsystematic. Systematic part is diversifiable. Other way around. Unsystematic part is diversifiable. Systematic part is non-diversifiable. And we all know the expected returns on the unsystematic bit is risk-free rate, and the non-diversifiable is risk-free rate plus risk premium. Is the risk premium portion that can be hedged. The hedging deals with the risk premium part. Okay. So how does that work? Basic story of CAPM, capital asset pricing model, or the security market line. Horizontal axis is the beta risk, vertical is the return. Your risk-free rate, zero risk, or higher risk, higher return. So that's our standard story. Traded asset should be on this line with zero net present value. Let's say Boeing. Boeing will be somewhere here given its beta, and that'll be the story for risk and return. But Boeing doing a private project will not be on the line. It'll be either above with positive net present value or below negative net present value. Okay. So Boeing's activities will have positive NPV. Boeing stock will be zero NPV. Okay. So A, B, and C are what we just said. So here is what risk can, here's the impact of risk. So what you're looking at is from the textbook. Few different investments, $1, 100 years ago. What happens 100 years later? So $1 invested in safe investment, treasury bills. Let's see how big it gets. 20-fold. If you invest that in small stocks, not one or two, but a big portfolio, 27,000. Compare 27,000 with 20. 20 is guaranteed. 27,000 is not. So that's where you see this line going up and down. So in the long run, risk does pay off based on this history. The price today is expecting positive returns tomorrow to take care of the risk. Sometimes I lose, sometimes I don't. On average, it's upward sloping. So if you have a long horizon, $1 grows to 27,000, albeit with up and down movements. Okay? So it does show the risk reward trade-off here, conceptually. So here is, let me see if I can turn it around. So I charted very quickly from Fidelity, 5 investments. SPY, the S&P 500, there's a broad indices. UPRO, it's a traded asset, which is 3x the SPY. So whatever happens to S&P 500, this will give you threefold every single day. So it's a daily 3x return. QQQ is another top 100 technology stocks. And TQQQ is 3 times. Okay? So let's see what happened. If you had bought SPY over a 10-year period, your 10,000 would have been 30,000, threefold. If you bought QQQ, your 10,000 would have been nearly 50,000, fivefold. Okay, oops. So that's the line here, 30,000, 50, the bottom 2 lines here. But if you had bought the 3x, the TQQQ would have been here, 600,000. Okay. So yes, it's risky, it's going up and down hugely. But over a 10-year period, see what happened. 10,000 invested could have been 3 to 5-fold, 30 to 50,000, or 600,000. And this is not some stock picking. This is just 3x of the broad index, S&P 500 and the QQQ. Okay, this is real data. So the 3x, although it's very risky up and down, in March 2000, it fell from nearly 600,000 way down to 150,000. But then it went back up to 600,000. Okay, so yes, there is risk, up and down movement, but in the long run, that risk appears to pay off. Right? It's something to think about. We can talk more. All right, so risk management is either pooling, as in form portfolio. An example is fire or theft insurance. It's pooling. Versus sharing, multiple shareholders, like every company, Boeing has multiple shareholders. Each one has portion of the risk. Or transfer, hedge, as in what the Archegos did with Credit Suisse. The transferring or hedging can be done with forward contract or swap. And these instruments, by the way, are not just textbook examples. The size of these instruments is mind-boggling. $600 trillion, there's no mistake here, 600 trillion outstanding. And the swap and the forward contracts, I'll show you in a minute, are worth 600 trillion, when the US gross domestic product is 30 trillion. 20-fold, 20 times the size of US economy are these instrument hedging bets. Here we go. Next page. And I'll show you the data shortly. So what is hedging? Very quickly, a risky project. For example, coin flip. Heads you make a dollar, tails you lose a dollar. So label 1 is a project with expected value 0. Project effort 2, label 2 is a hedge, which is the opposite bet. Heads you lose a dollar, tails you make a dollar. Combine 1 plus 2 is a hedged portfolio. So let's see numbers wise, +1 -1 is 0, -1 +1 is 0. So there's, no matter what happens, head or tail, there's no change in the outcome. So that's the risk management there. But look at what happened to the expected value. It's unchanged. Whether you hedge or not, the expected value does not change. Okay. The point of the story is risk management is value neutral. Risk management is value neutral. In plain English, it's valuable, but in economics, it's value neutral. Okay, it's safer, it's good to have insurance on my house. It doesn't add economic value in expected value terms. Okay, a simple example is, if my house is a small portion of my wealth, let's say I'm Warren Buffett, do I need to buy a house insurance? Does it make smart decision to buy house insurance? And the answer is, if you can handle the downside, there's no need to buy the insurance. It doesn't change the expected value. You don't get richer by buying the insurance. Boeing can self-insure, not can, Boeing does self-insure for property and casualty. Okay? They don't need to buy insurance. They can afford it. Seattle University is a small outfit with maybe 200 million annual revenue size, can self-insure for employees' healthcare. And Seattle University is not alone. Many employers do that. Why is that? Because that process aggregates the, it's an unsystematic risk. That's why you can, in a large portfolio, get rid of that risk. So I was in Hong Kong talking to Cathay Pacific, which is a Hong Kong-based operation, but they have primarily Japanese traffic. It's a yen revenue. The costs, airplanes and gasoline, are in dollars. And the profits, John Swire Group owns it, is in pounds. So what does Cathay Pacific do with yen revenues, dollar costs, and pound profits? And my students asked the CEO, how do you manage the risk? And he says, I do and I don't. So here is what he said. Partial hedging is all he does to keep daily operations safe. In other words, currency fluctuation should not affect his ability to operate daily. A large portion is left unhedged because hedging is value neutral. Why bother? Except for the risk. If you can't take the downside, if I'm Warren Buffett, my house burns down, it's okay, I can rebuild it. Just hedge to protect short-term operations. That's what it does, and that's theoretically a smart thing to do. So here is one thought. Business risk, if you don't like it, if you fully hedge, if Boeing hedges every little risk completely, Boeing will have risk-free rate for return. That's not what you want. So that's the flip side. You do want to carry risk. And why do you want to carry risk? Here is why. Here is why. The positive NPV projects that Boeing has, they're risky. But don't hedge the risk there. If you do that, you'll have risk-free return. That's not what you want. You want to carry risk on these projects. They may be positive, they may be negative. You don't really know. You expect, you hope they're positive. You work, you eliminate all the uncertainties. But there's still residual uncertainty. So to keep the bets on positive NPV, Boeing does want to carry that risk. Okay. So let's move on to the tools. We're about 15 minutes. So tools are, I'm sorry, we're about 5 minutes. Let me speed up. Tools are forward swap, and these are over 600 trillion, like I said. Short story, a farmer sells the corn output forward. So 1 year later, when the time comes, he produces a bushel of corn and gets the fixed number, $3 per bushel. Uncertainty is taken care of, or is it? Not quite. What if the output is suddenly zero because of doubt? So price per bushel is fixed, but the volume is not guaranteed. Could be a super large loss, particularly in a drought. What happens is the spot price shoots high, forward price is locked, farmer has zero output, farmer loses. Okay. So here's a quick example of a swap. Boeing borrows at a floating rate and Boeing wants to pay fixed rate. So how do they do that? So here is the straight borrowing at a floating rate, and here's a swap. So the L floating rate going out comes in from the swap dealer and goes out. The fixed rate, Boeing pays. So on the net, they'll end up with the fixed rate. So swapping out of floating into fixed can be easily done with the swap, and those do exist. Here we go. So this is from the Bank for International Settlements. Global over-the-counter derivatives in billions of US dollars. Okay, these are in billions. How much are the swaps? All contracts, foreign exchange and swaps are right here. $600 trillion. Okay? In billions, this number is 600 trillion. $600 trillion of contracts. Roughly 100 trillion is foreign exchange, and the remainder is interest rate contracts, 500 trillion. Okay. Compare that with the US economy, 30 trillion. Okay. These are actually out there. And it's not just overnight, suddenly. It's over time, last few years, the number is nearly the same, 400, 500, that range. Okay, give me 2 more minutes. So swap is hedge fund and swap dealer exchange returns on asset A and asset B. It doesn't matter which asset. It's a fair zero NPV transaction. A says to B, hedge fund says to swap dealer, I'll give you return on asset A if you give me return on asset B. Any defined asset. A can be, say, a LIBOR. B can be, say, a bundle of defined stocks, XYZ. Notional principal is the base. Return on how much? Investment. Say 100 million for each A and B. So Archegos Capital and Credit Suisse is the example here for a total swap. Here is one use, legitimate use, not a bet. Pension fund manager, say has a 100 billion stock portfolio, wants to get out of stock and for a week. Logistically nearly impossible without affecting market price. You can't go out, start selling 100 billion worth of stock. So what do? You do a swap. Find a swap dealer, and pension fund says, I'll pay you performance off the 100 billion, up or down, whatever percentage. In return, you pay me performance on bonds worth 100 billion, all defined. So defined assets result, up or down, is paid by A to B. In return, defined assets, say bonds, is paid by the other party. Okay, so this action, in essence, pension fund is selling the stocks and buying the bonds without actually doing so. Okay. Swaption is option to do the swap. And here is one story on swaption. CS is city of Seattle. And I brought this up to show you even a small city like Seattle does these things. So what they did do, in summary, is sold a callable bond and did a swaption. Put the two together, the call feature in the bond disappeared, and they have a non-callable bond. Okay. So doing a swaption, in essence, is selling the call feature on a callable bond. There's no direct market instrument that does that. So selling a swaption creates the call feature on the bond. And City of Seattle can afford to sell it because they can buy that call feature by issuing a callable bond. So this is the story. They sell a callable bond and then sell a swaption and end up with a non-callable bond. But what happened here is the price of the swaption is higher than the price they paid on the callable bond. So it's beneficial. It's an arbitrage in some sense. Selling swaption is effectively the same as selling off the call feature on the callable bond. Okay, I kind of ran through, but it's time for me to stop. So, Ramakrishna, are you there?
Professor Ramakrishna, yeah, you could take. We had, sir will take in some questions. So I think there are already a few questions in the chat box. I request Ramakrishna to put it for the professor. And anyone else who would like to ask questions, please unmute and you can ask question directly.
Another floor is open for questions. You can type the question in the chat box, or if it is lengthy one, or if it is brief, you can directly ask the professor.
Sir, am I audible?
Yeah, you are.
Yes,
please
sir.
go ahead.
Yeah, Pratish.
So, sir, it's a little lengthy, but I'll try to make it a little more crisp. This is like in lieu of the real estate bubble of 2000. This is in lieu of the real estate bubble of 2008 financial crisis. So initially, the surveys that were taken were shown that people had a higher confidence as far as real estate industry or real estate sector was concerned. Whereas when it started falling, people started having like just the opposite stance on the matter. So they thought that it would be not feasible to invest in real estate. So basically, there was a big bubble that was there for the real estate sector. So my question is, in respect to the pandemic, if sir could maybe share some insights and maybe some predictions as well.
Towards the end, you referenced the pandemic as in what happened last year, its impact on the economy?
Yes, sir. At least in like with respect to the real estate sector, maybe.
we can all share our ideas. I don't have any information other than just my impressions. And in the US, to me, it looks like, I could be wrong, to me, it looks like our interest rates are so low, near 0%. And money is so easily available. Federal Reserve is pouring money to save the economy. And if you look at the stock market results, it's reaching for the sky. Price to earnings ratios are around 30 to 40 in that range, not 15 to 16 that they used to be. So enormous positive outlook about future. So stock market is one, and second is the real estate. It has taken off. Prices have nearly doubled in the last 5 years in many cities, including Seattle. I don't know what's going on in Hyderabad, but I'm sure there are local impact of easy money. Not sure if it's that easy in India, but my guess is it is similar, if not same, as the US. I'm not sure that helps you, but those are my random thoughts.
Sir, if I can build on that question, what are the key differences you have noticed between the subprime crisis and the global pandemic? And second question is, do you support these low interest rates? Will they fuel a different kind of a bubble in the years to come? What are your thoughts?
It's a good question. And the Federal Reserve was asked exactly that question. And their response is they're playing between keeping the economy strong by by having the rate higher, not too low, and keeping the rate lower to make money easily available, trying to find a balance. And they would rather make the mistake by having it low a bit too long than the other way around, that having it too high a bit too early. So they're fully aware that the low interest rate may lead to a bubble, but they're also afraid that raising the rates too soon may have the opposite effect. And it's easier to deal with a bubble in their judgment than to deal with going in a hole. You can see what happens when the panic begins with Lehman. Good assets get damaged with the panic. So it's no fun dealing with the negative side of the bubble. What's a good word for it? Going in a hole. So the Fed is fully aware and they're trying to find the balance. That's the best I can say. Share your thoughts too. I'm not an expert, the only expert here.
I may ask one more question, Professor Ramakrishna. Sir, in the US, low interest rates may be justifiable. But in India, do you agree with this kind of ridiculously low interest rates in India? Because these low interest rates are not leading to any investments, sir. They're only being used by companies to refinance their existing loans or by the government to reduce the fiscal deficit. The whole purpose of interest rate is to boost investment. That doesn't seem to be happening in India. I have a point of view here. I'm just expressing my point of view.
I think it was for you, Ramakrishna.
The question is for you, sir.
Oh, for me. Okay. I can speculate. I don't know much about what's going on in India, but in principle, what you said happened here too. Corporations are taking advantage of the low interest rate, and nothing wrong with that. I remember calling Costco CFO, and was checking Costco and Boeing and the balance sheets, and the current liabilities were larger than current assets, a negative working capital. And I wasn't sure what was going on. So I called him and he said, I can't pass up borrowing at a nearly 0% interest rate. And it makes my working capital negative. That's okay. It's not a sign of anything. It's just I borrowed short term instead of long term. And when the rates go up, I can always go and borrow long term or issue equity. So corporations, even in the US, do take advantage of the low interest rate, and they should. Now, once they have relaxation of capital constraints, will they invest more? And I can only guess. I think they will. Individuals, even in the US, from what little I know, are not outspending with low interest rate. There seems to be a more tendency to start saving. And it seemed like you wanted the opposite. You wanted people to borrow at low interest rate and start spending wild. So my guess is the individual the consumer level will pick up later, and the industrial level will pick up earlier. And that's just a guess.
A few questions in a chat box. I just summarize them in short. One is that the COVID-19 is going to be a bubble, is similar to a 2008 financial crisis. And what about increasing inflation? And when there's a bubble, why is that the stock market is soaring? Normally it has to crash, but still day by day, even in a pandemic scenario also, the markets are rising globally, especially in Indian market is skyrocketing unprecedentedly. So what may be the reasons for this? And how long this is going to be? Yeah, whether this will be a
hard to say,
sustained
but I'm not surprised at all that the stock market is flying high. If you keep pouring money with low interest rates, it has to go somewhere. And real estate and stock market have been flying sky high in the US. I haven't paid much attention to India, but it sounds like it is. And the Fed will try to guess when is the right time to raise the rates again. And like I said, they would rather be a little late than a little early. So can you expect potentially bad things happening with the economy? I think Fed is waiting to see the initial signals of inflation before they act, rather than act preemptively. They make a choice between inflation and deflation. And they would rather take inflation to avoid the deflation. My sideline thought about deflation is nobody knows how to deal with it. And the reason for that is if prices start falling, all of us will say, I'll buy tomorrow. And that's why prices fall even more. So we look tomorrow, prices are lower yet. And we say, I'll buy tomorrow, not today. Keep going. So the lower prices go, the lower they go. It's a downward spiral. Inflation is the opposite, it's easier to deal with. We know prices going up by 2% in the US it seems to help the economy rather than hurt. I'm not sure that helps you with my random thoughts.
Is there a question, sir? Is there any systemic or regulatory norms required to tackle this kind of a bubbles, recent bubbles and all? Any regulatory kind of norms which either at a Fed or at any central government, from central government or government agencies?
The Federal Reserve has limited powers, right? Interest rate. That's primarily what they have. And the Treasury tries to control the money supply. And the US probably has more latitude than India, in part because it's a bigger economy and in part because other countries depend on the US dollar. So my guess is the US economy will improve first and others will catch up. So India, I'm not sure what's going on, but it's not surprising at all that low interest rates will lead to higher stock prices and higher real estate prices. And in some ways, I would rather have that than the other way around. If you have low interest rates and you see stock prices falling and you see real estate falling, I don't know what to do.
Okay, we'll stop at that. Thank you, Professor Datar. I think your interaction covered a lot of issues. It brought to light the importance of equity for the financial system. The challenges of taking in more leverage. Perhaps fueled by lower interest rates. The use of synthetics, where the class of synthetics, the value of those assets were much more than their their underlying assets. And also in terms of the liquidity crisis, I think, more so the subprime crisis brought to light the importance of liquidity. So you might be having AIGs and Raymond's billions of dollars of assets, but what's the point, when you cannot liquidate it or at the market price when you actually require it. We've also given some examples of Archigo and Cathay Pacific, and in the long run, how equities are definitely, are an asset class to bank on. And you've also covered a little bit on risk management, including swaptions and swap options. I'm sure all of us have enjoyed your interaction. We look forward to a lot more. I'd like to thank Professor Ved for making it more interactive. I'd like to thank Dean Sarijan. I would like to thank Banu Sirisha ma'am and Club Prayas, and always special thanks to Narasimhachari Garu and his club on money matters. And Ramakrishna sir is I think got the right connect at the right time. I think to set our ball rolling. And from our department, I think this is the first international seminar. We'll be catching up with a lot of others soon. We'll be updating you. Thank you very much, sir, for spending your time. And I hope that it'll go on for a long journey and a good relation between you and our university. Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you.
It's a matter of privilege for us to have such a great scholar like you. And so many comments have come on the chat window, sir. Thanking you for this wonderful lecture.
Thank you all. Thank you very much. Have a good day.
Thank you.
Thank you, sir. Have a good day.
Thank you, sir. Have a
Bye.
good day.
Bye.
Yeah, I request you to switch off the thing. Thank you, all of you. Thank you, all the club members, for helping us through. And I think it was a wonderful evening. Thank you, all of you, all the faculty and others who joined us. Thank you. Bye. Good night.
Good night.
You can stop the streaming also. Raghav,
Chari, sir.
yeah.
Chari, sir,
Yes, sir.
yeah, I'm there.
We'll do it, sir. We'll do that now. Streaming stops, sir.
Okay. Thank you. Okay, sir. Ramakrishna, sir.
Thank you, sir. Well, sir, thank you.